Welcome to The Deep Dive, your go-to for cutting through the noise and really understanding the most important financial updates. Today, we're putting Cooper Company under the microscope, specifically their Q3 fiscal year 2025 results. Think of this as your personal shortcut to decoding what their performance truly means, not just for them, but for the entire healthcare and medical device landscape.
Exactly. And Cooper delivered a fascinatingly mixed quarter. You saw clear operational strengths, definitely. But even as those shone through, some top-line challenges sparked a notable market reaction. So we're going to dissect their vision and surgical segments, break down their updated guidance, and most importantly, connect these dots to the broader market trends that matter to you.
Okay, let's jump straight into the headline numbers then, because these really paint a telling picture. Cooper Company announced consolidated revenue of $1,060.3 million. Now, that's a 6% increase year over year. But when you strip out things like acquisitions and currency fluctuations, the organic growth, it was a more modest 2%. And this figure, crucially, landed just slightly below what analysts were expecting.
Right, a slight miss there. But here's where the story gets more interesting, I think. Profitability was notably stronger. Their non-GAAP EPS, that's earnings per share, it surged an impressive 15% year over year to $1.10, comfortably beating the consensus estimates. And we also saw some healthy margin expansion across the board. Non-GAAP gross margin improved 70 basis points to 67.3%. And non-GAAP operating margin was up 60 basis points to 26.1%. So they were just making money. They were doing it more efficiently.
Okay.
And to cap it off, free cash flow looked robust at $164.6 million. They even actively repurchased about $52.1 million of their own stock.
So we've got a clear beat on the bottom line, powerful margins, good cash flow. Yet that slight miss on revenue, it's almost a tale of two halves, isn't it?
It really is.
And the market's initial reaction, that pullback, it really underscores that investors were hyper-focused on the top-line performance, maybe overlooking some of those underlying operational wins. Kind of begs the question, how do we reconcile that strong profitability with the revenue slowdown?
That's the core tension, isn't it? And it highlights a broader market theme we see sometimes. Even when a company is incredibly disciplined on profitability, like Cooper seems to be here, if that top-line growth falters even a little, the market sends a strong signal. So we really need to dig into why that revenue miss happened, see if it's just a transient issue or, something more structural.
Okay, let's unpack those results further then, segment by segment. First up, Cooper Vision. This is their big contact lens business. What were the key drivers and, maybe more importantly, the headwinds they faced here?
Right, Cooper Vision. Revenue was $718.4 million. Organic growth came in at 2.4%, which actually was below their own internal expectations. And two main factors really drove this. Firstly, and this was quite surprising, we saw a noticeable global decline in their Clariti daily hydrogel lens sales. It was particularly prominent in Asia Pacific, but you also saw slowdowns in the Americas and EMEA. Now, management attributed this to customers shifting faster than anticipated to their more premium daily lenses, specifically MyDay. They actually stated that the significant increase in MyDay fitting sets and trial lenses, quote, meaningfully impacted Clariti Go orders.
So that's a fascinating strategic tension right there. Cooper is successfully upselling customers to a higher margin product, MyDay, which is great for long-term profitability.
Absolutely.
But the unexpected speed of this transition is creating a short-term top-line headwind. It's like upgrading your phone, maybe. You love the new features, but then you realize you're getting rid of a perfectly good, reliable device a bit sooner than planned, just because you want the new one now. This really forces us to consider how quickly a good problem can ripple through the financials, affecting market perception right away.
Exactly. It's a classic example of product cannibalization, but like you said, with a positive spin for long-term margins. The second headwind was a greater than expected weakness in the pure play e-commerce segment. This was in Asia Pacific, excluding Japan. It sort of mirrored challenges they had seen back in Q1 in China and some other smaller regional markets. Part of it was due to aggressive competitor pricing, which Cooper chose not to match. A clear profitability over volume decision there. But importantly, the impact on overall profitability from this specific channel weakness was minimal. Its margins were already very low.
Okay, so the Clariti decline, even if it's mostly due to that shift to MyDay, still seems significant. Does this signal a broader market trend away from hydrogels, maybe? Or is it more a Cooper-specific dynamic? And speaking of MyDay, what were the standout positives there beyond just fixing those manufacturing constraints? This is their flagship daily silicone hydrogel lens after all.
Yeah, MyDay was definitely a key positive highlight. And it does speak to that broader market trend towards higher performance lenses. Those manufacturing constraints that had previously limited its availability, they're now fully resolved. Gone. Which allowed for an accelerated global rollout of fitting sets and trial lenses. So MyDay achieved double-digit growth this quarter. That includes its most innovative lenses like torics, multifocals, and Energist. MyDay multifocal specifically grew an impressive 20%.
Wow, 20%.
Yeah. Plus, they've secured and renewed several large private label contracts that actually feature MyDay as a significant growth driver. And looking ahead, there's a digital boost MyDay lens slated for an early fiscal year 26 EU launch. MyDay multifocal is expanding into several major Asia-Pacific markets too, and MyDay parameter expansion, just getting more options out there, is well underway.
That MyDay ramp-up really sounds like a turning point, a strategic success, even with that short-term Clariti impact you mentioned. But let's dig into another long-term play they have, their myopia management product, MiSight. With new regulatory approvals, expansions, how significant is this product becoming to Cooper's overall strategy, beyond just being a growth driver, I mean?
MiSight continues its strong performance. It grew 23% this quarter. A lot of that was driven by a record-setting quarter in EMEA, actually. Increased fitting activity, customer engagement there, and its strategic significance is huge, you're right, because it addresses a growing global health concern, childhood myopia. It positions Cooper at the forefront of a specialized high-growth market. And in a really significant development, MiSight received final regulatory approval for launch in Japan. Commercialization is planned for early fiscal year 26.
Japan is a big market.
Huge. And they're also preparing for the launch of MyDay MiSight, sort of a combination product across Europe and select Asian countries in the first half of 2026. Management seems firmly on track to hit that $100 million in MiSight sales for this current fiscal year. That's a major milestone for them.
Okay, so while CooperVision presents this fascinating study in product cannibalization and strategic shifts, let's pivot our gaze to the Cooper Surgical segment. Did we see similar market dynamics play out there, or was their story quite different?
Cooper Surgical's revenue came in at $341.9 million. That's growth of 4.5% reported, 2% organically. Here, the story has its own unique texture, I'd say. Within this segment, you have fertility. Its revenue is up 6% reported, 3% organically, driven by strength in genomics and consumables, and some market share gains in EMEA. However, that market still faces headwinds. Clinics delaying capital purchases, meaning big-ticket equipment sales are slower. And softness in APAC cycles. They even specifically mentioned the year of the snake impacting China's fertility cycles.
The year of the snake impacting fertility cycles. That's a fascinating and, wow, quite specific detail. Really highlights the nuanced global factors that can influence different market segments, doesn't it?
Absolutely. It shows you how granular things can get. Then we have office and surgical sales. Those grew 3% year over year, 1% organically. This growth came from their labor and delivery portfolio and specialty surgical devices. OBP Surgical, a recent acquisition, showed strong growth too, 23%, but this was offset by a 10% decline in Paragard sales. That followed some strong advanced purchasing in prior quarters, so maybe just some lumpiness in purchasing patterns there.
Right, smoothing out after a bulge. Okay, now for the forward look, the guidance updates. How are they seeing the rest of the year, and maybe looking further out into fiscal year 2026? This is often where the rubber meets the road for investor sentiment.
Definitely. So for Q4 fiscal year 2025, consolidated revenue guidance is set between $1.049 billion and $1.069 billion. That represents about 2% to 4% organic growth. Non-GAAP EPS is guided to $1.10 to $1.14. Now, this guidance does factor in a few key headwinds we've discussed. Continuing Clariti softness, the slow conversion of MyDay fitting activity into actual revenue risks in APAC e-commerce for CooperVision, and also that persistent softness and fertility for Cooper Surgical. So they're acknowledging those challenges.
Okay.
Gross margins are expected to be slightly lower year over year, mainly due to tariffs and that product mix shift. Remember, MyDay is slightly lower margin than Clariti right now, but management anticipates offsetting this with operational execution. They seem confident there. And free cash flow for Q4, expected to be roughly $100 million.
And what about the full year picture for fiscal year 2025? Any shifts there based on Q3?
Yes, there were shifts. For the full fiscal year 2025, revenue guidance was trimmed. It's now $4.076 billion to $4.096 billion. That's down from the prior range of $4.11 billion to $4.15 billion. And that reduction is primarily due to the Clariti softness and the APAC e-commerce weakness we talked about. However, and this is important, non-GAAP EPS guidance was actually raised to $4.12, reflecting that strong margin performance and disciplined profitability management.
That's the key pivot, isn't it? Trimming revenue but raising EPS guidance. You mentioned earlier the market prioritizing top-line growth. But if management is truly pivoting to this profitability discipline and focusing on free cash flow, isn't that a mature, responsible move? Shouldn't that be rewarded? Is the market maybe overreacting to short-term revenue noise? Or is there a valid concern that this profitability focus might stifle future growth in what's still a competitive landscape? So with that context, what about the outlook for fiscal year 2026?
That's precisely the debate playing out, I think. Management is clearly betting on the latter view that discipline pays off. They expect sustainable revenue growth and market share gains in FY26. CooperVision aiming to outpace the contact lens market overall, and CooperSurgical seeing a rebound in the fertility market as those headwinds potentially ease. They also anticipate operating margin expansion by leveraging prior investments and becoming, a more efficient organization. Plus, those tariff mitigation strategies are expected to reduce the impact by about $24 million lower than previously feared. That's a nice little tailwind.
Helpful.
And crucially, with the completion of CooperVision's big capital expenditure cycle for MyDay capacity expansion, they project much stronger free cash flow. They're targeting approximately $2 billion over the next 3 fiscal years. That's a big number. And this cash is earmarked primarily for deleveraging, paying down debt, and share repurchases. It's a really clear signal of a shift, moving from a heavy investment phase to a cash-generating one. They also mentioned ongoing productivity and efficiency initiatives, with more details promised on the next earnings call.
And just quickly, for those of us tracking these sectors, how do their products fit into the broader market context? What are the sort of macro trends influencing Cooper's trajectory right now?
Good question. The contact lens market, broadly speaking, is expected to continue mid-single-digit growth, driven by key trends like the ongoing shift to silicone hydrogel dailies and increased adoption of toric and multifocal lenses, which, as we said, MyDay is perfectly positioned for. However, global pricing is expected to be a bit lighter, maybe around 1% price increases compared to stronger pricing in prior years. And the fertility market, that's expected to improve as APAC cycles hopefully return to normal and clinics resume those capital investments. That should boost CooperSurgical. So the underlying market trends are generally favorable, despite these near-term hiccups Cooper's navigating. So you've heard the numbers, you heard the segment details, and the immediate market reaction to all this was quite distinct. Despite that beat on the bottom line, despite raising the EPS guidance, the stock saw a significant pullback. Nearly 12% in after hours, I believe. This just vividly highlights that the market right now is heavily prioritizing top-line growth, and it's expressing concern over that revenue slowdown, particularly those channel-specific weaknesses in Clariti sales and APAC e-commerce.
Yeah, it really signals that investors are keenly watching. Can CooperVision re-accelerate back to that market-like mid-single-digit growth, especially given management's confidence in MyDay? It's almost like a test of their strategic pivot, isn't it?
Exactly. Management is clearly pivoting towards profitability discipline, as you called it, and strong free cash flow generation. Now, this is a strategic choice, and it needs to be carefully evaluated against the market's seemingly insatiable demand for top-line expansion right now. The Clariti MyDay dynamic is particularly interesting here, I think. While MyDay's resurgence is undeniably positive long-term, its faster-than-expected impact on Clariti orders created this near-term revenue drag, especially in regions like APAC, where maybe the products were seen as more similar. Because that MyDay fitting activity, putting trial lenses in people's hands, it just takes time to convert into actual consistent sales. And this dynamic, the sheer magnitude of it, frankly seemed to catch management a bit by surprise.
So we're talking about a good problem, customers upgrading, but one that comes with a temporary revenue hit, and maybe a messaging challenge to the market as well. Given all this complexity, what are the absolute key catalysts for future performance, the things you're watching most closely?
Okay, key catalysts. First, the successful resolution of MyDay's manufacturing constraints and that accelerated rollout, including those new private label contracts that's critical. Need to see that translate to sales. Second, the upcoming launch of MiSight in Japan and MyDay MiSight in other regions. Those are significant growth vectors that could really move the needle. But perhaps the biggest catalyst, honestly, is that $2 billion free cash flow target over the next 3 years. It's driven by finishing that heavy capital expenditure cycle for MyDay. It positions them for substantial capital allocation flexibility, focusing on debt reduction, buybacks. This shift from a heavy investment phase to a cash-generating one, that could be a significant re-rating event for the stock, assuming, of course, that revenue reacceleration eventually materializes.
Right, the assumption is key. And it sounds as analysts on the call were really pressing management hard on the timing of that MyDay revenue conversion and also the true extent of the APAC e-commerce challenges, just seeking more clarity on how these headwinds will actually be navigated. Those organizational restructuring and productivity initiatives you mentioned, they could also provide further operating leverage, maybe offsetting some potential gross margin pressures from product mix and tariffs. There's just a lot of moving parts here, aren't there? Could make a big difference down the line. All right, now this is the part where we get a little unconventional. But, always with a method to the madness. And remember, very clearly, this is not financial advice, purely a thought experiment exploring the extremes of market perception.
Okay, ready for the wild idea. Given the market's significant, almost knee-jerk reaction to that top-line miss, that nearly 12% drop after hours, while arguably overlooking the robust free cash flow outlook and the operational discipline we've talked about, here's a plausible, if slightly outrageous, trade idea. I'm thinking a long straddle on Cooper stock, expiring roughly 9 to 12 months out, and specifically targeting an entry after the initial dip has maybe stabilized a bit, but crucially, before the Q4 earnings print comes out.
Interesting. A long straddle. For those less familiar with options, can you quickly explain what that is and why you'd consider it here, given the situation?
Absolutely. So a long straddle involves buying both a call option and a put option on the same stock. Same strike price, same expiry date. Essentially, it's a bet on significant movement in the stock price. In either direction, up or down, you don't need to predict which way it'll go, you just need it to move a lot to overcome the cost of buying both options. Now, the current implied volatility, that's the market's expectation of how much the stock price will swing it, was elevated right after earnings, around the 95th percentile, very high. That makes a straddle expensive right now. But if the stock finds a floor after this immediate market indigestion, that implied volatility might drop a bit. That could create a better entry point.
Okay, so you're betting on volatility. Betting on the market being fundamentally wrong about Cooper's future trajectory, either too pessimistic or maybe not pessimistic enough. Lay out the full pitch for us. Why this bet? Why now? Or rather soon?
Here's the thinking. The catalysts we've discussed, they feel binary and potentially chunky. On the upside, MyDay's revenue conversion could surprise significantly, especially with those 30-plus new private label contracts, that 300% increase in trial sets they mentioned. If management's at least at market growth guidance for FY26 proves conservative, or if MyDay truly takes off faster than their cautious Q4 guidance implies, the stock could see a substantial upward movement. The call side of our straddle profits handsomely in that scenario.
Okay, that's the bull case.
Right. Alternatively, on the downside, if the Clariti decline accelerates further than expected, or if that APAC e-commerce issue proves to be a deeper, more structural problem, maybe leading to another guide down, then the stock could crater further. The put side of the straddle offers protection and profit there. The market, I think, is either underestimating the potential MyDay acceleration or else is overestimating the Clariti cannibalization and APAC headwinds. Either way, the stock could experience significant movement.
So a big move is likely, just unsure of direction.
Exactly. And underpinning all this is that $2 billion in free cash flow over the next 3 years. That's a massive deleveraging and buyback story that will eventually get priced in one way or another. If MyDay hits and the market starts to re-rate Cooper on an improved growth trajectory, the upside on the call side is substantial. If the headwinds persist and MyDay takes longer to convert than hoped, the put side cushions the blow and potentially profits. It's really a bet on the market being wrong about the magnitude of the future move, fueled by key events like the Japan MiSight launch and that digital boost MyDay lens coming down the pike.
Okay, quite the scenario. Let's recap this deep dive then. Cooper Company delivered a Q3 that was, well, definitely a mixed bag. Strong non-GAAP EPS, good margin expansion, but revenue fell short, mostly due to that Clariti softness and unexpected headwinds in APAC e-commerce. It's a complex picture, really. Short-term challenges versus these longer-term strategic plays.
Yeah, and management is actively addressing these challenges. They're clearly pivoting, emphasizing the strategic importance of MyDay growth, MiSight expansion into Japan, and that significant free cash flow generation coming post-CapEx cycle. While the market's immediate negative reaction highlights its sensitivity to top-line growth right now, the underlying operational discipline and strategic initiatives could position Cooper for a powerful re-acceleration down the road. The question for you, the listener, is whether that strong profitability and future cash generation ultimately outweighs the current revenue anxiety in the long run. Food for thought.
As always, the information we've shared here today is strictly for educational purposes. It should absolutely not be considered financial advice. We highly encourage you to conduct your own thorough due diligence and form your own conclusions based on your research. Thank you for tuning into the deep dive. We always appreciate you lending us your ear, and we look forward to our next analysis.